Hi, I'm Jimmy.
Hi, I'm Mikey. Welcome to Learn to Invest, and welcome to our DCF calculation demonstration, pretty much.
Yeah.
We're going to start showing you our DCF calculator, and when Jimmy deems that the calculation isn't popular for this, we'll show you we have we got price to book value.
Price to book, we have, okay, so.
Price to tangible book value.
Yep, good for financial stocks. Price to adjusted funds from operations, good for REITs, things like that. So one of the questions we get asked a lot is coming up with a fair value for a lot of companies. The issue is discounted cash flow works with many companies, but it doesn't work with all of them. So as you guys are throwing out tickers, by the way, we turned on slow mode to prevent the very few people that go ticker. Yeah,
pretty much.
Same ticker 97 times. Put it up there. We are trying to get to as many as we can. We'll show you. We'll show you as we're walking through.
And tell them about the website.
As always, I will. Let me show you here. As always, if you guys want to sign up to get access to this website, there will be a link in the description below. And basically, we are going to have the website up and running. We're hoping we keep saying by the end of June. I'm hoping it's before that, but by the end of the June is the deadline.
We're hopefully giving you the worst case scenario with you.
Yeah, that's the plan. But basically, this will be how it works. We've cut deals with different data providers to get analyst estimates. This is an actual calculation for Amazon. I've been working with them with different programmers for how to make sure we get the math correct so we can change it. If you don't want to use 3 years, you want to use 1 year or 10 years, or, whatever you wanted to do, it would do it. If you don't want 7.5%, we want it 8.5%. Well, we could do, you could adjust the calculation simple enough. Now, for me, I'm using 7.5%. We are also pulling down the company's weighted average cost of capital. That's the more textbook way of doing it.
Or you might hear it called WACC.
WACC, yeah, WACC is the shorthand version of it. Beyond that, we should probably... simple DCF doesn't work for Amazon. So here's one of the things. We're getting 3 years of analyst estimates. I've done back testing. What is the best time frame to project out? 3 years I have historically found works quite well. Now I tested that on companies in the S&P 500, which tend to be larger companies. Doesn't work for financial companies, doesn't work for REITs, doesn't work for smaller, super fast growing companies. Amazon, I would hesitate whether or not it works here all that well, because 14 billion, 37 billion, this is free cash flow. This is what analysts, there are 25 analysts. On average, they are expecting 14.5 billion in free cash flow in 2022. Then 37.8 billion in 2023, 24 analysts. That's a ton of analysts. We don't have an issue with analysts. The issue with our numbers here is look at how fast that growth rate is. Now, on the website, the way we're accounting or adjusting for that is you could say, where discounted cash flow would work very well for Amazon is, let's say we go out 10 years. Now, I have the computer automatically calculate it, but those are some of the calculations we've been playing with the web developers that I want to make sure the math is reasonable. I actually don't think that this drop off right here is perfect, but it does get back there pretty quickly. Either way, with that, if we went out 10 years, where the website will be very powerful, is you can say, I don't want to go out 10 years. I want to go out 5 years. 14, 37, 58. I think it's going to be 65. Then it's going to be 75. And then we'll gradually decline it from there. We can make those adjustments on the website. It's a little tougher in Excel. So I would argue that right now, Amazon is still growing too fast to just say, because the assumption here is we grow like that and we drop off to 2.5%. I would argue that's actually why I wanted to start with this one, because that is one of the flaws. I know Amazon's down big and it looks super interesting. I'm going to do a deep dive on Amazon. I've never actually done a deep dive. I'm going to do a deep dive on this company. And when I do, I'm planning on expanding. I want to go out further. I can come up with my own projections. I'll start with analyst estimates, make adjustments where we need to, and then try to go out a few more years until it seems that they get to what I would predict to be a stable free cash flow level. Then the number would work out fairly well. I would bet you it was going to come out close just from looking at the rapid growth in early years. I'm guessing the fair value would be closer to 23, 2,400, maybe even 2,500. So, but take that. I mean, I got to do the research first. I can't really It's foolish to spitball numbers like that. Okay, that being said,
Speaking of doing the research, when we show you a good fair value, we want you to know that the fair value being green or at a point where we want it just means this is where we start researching it.
yeah,
We don't mean go buy it.
exactly.
We're trying to narrow down which stocks you're looking at and which ones are going to be a good buy. So when you see it like in a good fair value, that's when you start doing your research.
Yeah, because the research tells you everything.
Everything.
If you don't do the research, then you're just gambling. Just take a chance.
I didn't know that there was a pandemic last year. Why?
Yeah. Well, that's the other thing is that things can happen, and we sort of forecast that, and then we add a margin of safety, and then we say, you know what, stock like Amazon, I wouldn't need much of a margin of safety, but maybe you add 10%, and then that adjusts where you want to buy the stock. You want to buy it below that. So that's where we're going with this. Let's jump in, and Mikey's going to take the tickers.
They don't want to hear us talk. They want to see tickers.
Yeah, let's start punching them in.
What's Baba's been doing something. There we go.
Baba. Yeah, Bob is a stock that I own. Okay, another thing I wanted to bring out here is, let me adjust my unnecessarily large body here. Hold on. There we go. Okay, so you can see that we have this warning here. There's another warning here. We're actually going to put warnings on the website. And that is because what I'm afraid of is that people will plug in a ticker, go, oh my God, the stock, is up, it's, there's 10,000% upside, when in fact it was just because these numbers, these projections, if you want out further, those growth rates are being built off of previous growth rates. Now, if we're just using analyst estimates like we are, this warning doesn't actually apply to you. It only applies to you if you have the computer do calculations for further years. So in this case, it looks like fair value using 7.5%, which I use, that's a premium over AAA corporate bonds. We're getting to the point we're going to have to increase that soon because interest rates are going up. But even if you use the company's weighted average cost of capital, the stock still looks fairly undervalued. So down here at $98, this one looks really interesting. You got plenty of analysts. So I'd say that these numbers are probably fairly reliable, somewhat close to reliable. Another thing I want to point out over here, we got debt and cash. All of these calculations are adjusted for debt. We'll show you better examples later. But because they have more cash than they have debt, this is actually adding $35 in fair value. So if this one way to look at that, out of the $98, $35 of that is cash. They're sitting in cash. That assumes they take the $118 billion, they pay off the $21 billion in debt, they have remaining $35 per share in cash. That gets added to the value. If it was too much debt, it would take away from the value. So those numbers are there if you're looking for them. Okay.
All right.
Exxon Mobil. Interestingly, it still looks undervalued. Now, I do want to bring this out. $39 billion down to $28 billion. I guess I'm assuming analysts are expecting for a drop in oil prices, but that is something, one of the things that I think is very important that people do is that people sort of pay attention to that. People pay attention to look at what analysts are saying. If analysts are assuming there's a drop off, why? That could be a great place to start our research. But they have a current PE of 12.5. By the way, this is the sector. So the sector would probably be the energy sector. Sector average is 20x. Current PE, 12.5x. This stock looks like a good one to research. Plus, it's sitting over here at a 4% dividend yield. That's another thing we're doing. We're actually, because the stock is down so far, because the stock market's been down so much recently, we've actually started working on a few different videos. Some of our top value stocks, top dividend stocks. See what
top
companies,
3 in each one.
Yeah, top 3 or 5, some such number that we can see if we can come up with a good list of stocks to really start diving deeper into. Exxon looks like this could be one of them at 4% dividend yield. That's a pretty good dividend yield. Okay, what do we got next? So I like that. Whoever put that up there, that could be a good one to. If you own it, great. Looks like a good one to hold. If you don't, keep researching it.
1-800-Flowers.
1-800-Flowers. So, interesting. Analyst estimates. We got a couple. 4. It's not great, but it's not bad. I'm okay with 4 analysts. Looks like they're just about to start going free cash flow positive. in 2023. That's what analysts are projecting. Ignore that growth rate, that whole negative to positive thing. I've got to fix that. But you're talking reasonable growth. You know, this could be one of those examples that if we were doing our own research, we might extend out a bit further, come up with a more accurate fair value. But at first glance, it looks pretty good. I mean, $13 fair value, I think looks quite interesting. Yeah, overall, I mean, it looks like an interesting one. I like it.
I think I see Verizon on there.
VZ. Yeah. Again, another good one. I'm telling you, there's so many good names right now. Now, this is actually a good example. This is a good, an interesting one. $16 billion in free cash flow, 20 billion, 23. Plenty of analysts, more than enough analysts. And again, we're taking the average of all these analysts. So these are, these should be fairly good numbers. If you've ever looked at, how the standard deviation of analyst projections, they tend to be, there's a range, sure, but on average, that's why if you ever watch see a company report earnings or something and they say, oh, they missed analyst estimates by 3 cents. It was analyst estimates that missed by 3 cents. Do you know how difficult it is to get within 3 cents of what a company's next earnings report is going to be? Analysts tend to put in a lot of time to getting the financials as close as possible. I do trust analysts from that standpoint. I don't really trust them, frankly, from what is their fair value, because they change that so often to keep their...
Whether you should hold or buy.
Yeah, that I don't really like. Yep. But here is a good example of this. $62. Out of these two numbers, they have a low cost of capital. I would expect a low cost of capital on a telecom company like this. But I would use this one just because it's more conservative as the fair value. But that is after their $42 a share in debt. So if they paid off all this debt and used the cash, they had no cash and no debt, this stock would be worth 104.50, some such number per share. So that 62 is after accounting for that debt, which to me, I think you got to account for the debt. The debt, the cash, it's too important to ignore. Okay, what else we got?
I've seen this up there quite a bit.
T. Rowe Price. Okay, now you might notice black numbers, green numbers. Green numbers are analyst estimates. Black numbers are the computer. You might also tell that because we have 0 analysts there. One thing you could do is just say, you know what, just give me 2 years then. Just give me analyst estimates. And wowzer. That is significantly better.
Did you just say wowzer?
I'm sorry. It just surprised me. I didn't.
He's been watching cartoons with the kids.
Yeah, I got 2 little kids. That happens. Although I guess it didn't change that much. But you know what it is this third one went green. So that's why I apologize.
Yeah, that's why we got a wowzer, guys.
Even with 10.5%, which is slightly higher, anything double digits on a cost of capital perspective, I hesitate with. But it's not too high. If you said 9%, I'd be like, okay, fine. But even with that, this stock looks like it could be undervalued. The other thing to consider, this is a financial company. T. Rowe Price is a financial stock. Is this the right valuation method? Do you go to price to book value? Even price to book value. So this red line is the average. We want to buy it when it's below the average. And as you can see, each time it gets down here, I mean, the stock seems to bounce after that. So we're at a spot. T. Rowe Price looks like it could be real interesting to dig deeper into. So setting that back to 3 years and then passing it over to Mikey here.
CVS is hitting the chat.
CVS, I like this one. I like CVS in general as a company. I don't own it, but it is on my bullpen. And it's been there for a while. I just don't have, a position's worth of capital to jump in and buy this one just yet. But looks undervalued there. Now, they have a lower cost of capital. Usually, I like to go more conservative. So here, I would go with the 135. Add a margin of safety to that. I mean, this one looks fairly good. They got a lot of debt. You might not notice that with a company like CVS. You expect it from Verizon, AT&T. But they have $48 per share worth of debt. Net debt. So that's debt minus cash. You get about $48 per share. But even after that, the stock still looks undervalued. So... yeah, this one looks like a really good one to dig deeper into. Plus a 2% dividend yield.
I don't know. I always like to look at Walgreens while we're at this.
Yeah, another one. So I was always favoring CVS. This one has a better dividend yield, double the dividend yield. 7.5% cost of at required return, undervalued. They have a low cost of capital. Again, not too surprising. Analyst estimates. We got plenty of analysts. Oops. We moved our decorative line.
Wowzer.
We've been playing.
I'm going to be messing with you the whole show now.
Yeah, sorry about that. Okay, so current PE, look at that, 7.4. Compare that to sector 24x. Their own 5-year average of 13x. I mean, these stocks look like they're prime for, I
like both of them.
Prime for a decent run. Yeah. Go ahead, you could throw up the next one. The other cool part is with where the market is right now, I truly believe that this is the time that we're positioning ourselves for the future, obviously. But if you could pick good stocks right now when everything pulls back, it can make your portfolio for the next few years if you buy, in theory, good stocks at a good price. That's one of the exciting parts about having the stock market.
We suggest long-term investing.
Oh, yeah.
Here.
I much prefer long-term investing.
Yeah.
But here you got plenty of analysts, very reasonable free cash flow growth. Dividend yield, fine. Current PE, slightly below average. Probably above the stock market average. I think the stock market average is like 19, 20x, something like that. Long-term average. A bit overvalued right now, but yeah, overall the numbers seem reasonable. I just think it looks like it's a bit overvalued. We are taking a somewhat conservative approach, ending it at 3 years. We might want to, if you were doing the research on your own, you might want to extend it out a bit further, sort of bring it down a bit more gradually. But overall, it looks, it's close.
Who did that? There we go. All right, let's look at a couple banks.
All right, banks. Citigroup, negative 174. Why, you might ask? Discounted cash flow is not appropriate for banks. Banks don't generate free cash flow. So it might look like we are, but you'll see there's no analyst estimates, and that seems unlikely for a stock as big as Citigroup. If you're going to value banks, insurance companies, use either price to book value, price to tangible book value. Here is their price to book value. Here is their price to tangible book value. Long-term average, 10-year average for their price to tangible book value for Citigroup is 0.9x.
What's the difference between those two, just in case?
So the real difference between, it's really what it sounds like, price to book value and price to tangible book value is tangible book value it keeps only the tangible assets. So things like cash, things like that they're the important numbers for a bank. So ideally, we want to buy it below the average. Now, most textbooks say you should buy it when it's below 1x. And that is very true. If you paid 0.9, you'd be paying 90 cents for every dollar of tangible book value. The other thing about price to book value and tangible book value, ready? I'm going to go back and forth real quick. You'll see the charts, yeah, they're different scales, but they're fundamentally not that different. The shape is usually about the same. I like tangible book value, especially for banks, insurance companies like that. But at 0.6x, it's below the 5-year average, below the 10-year average. To me, it looks really good. Ignore discounted cash flow. So one of the things we're going to do is on the website, we're going to have a warning pop up. Phase one.
Not the best spot to be.
Yeah, this isn't the proper valuation method. Go check out this one. Have a link there, bring you over to that one. We're going to kick it off with just discounted cash flow, but shortly behind that, we're adding price to book value, price to tangible book value, price to adjusted funds from operations, and on and on. We're doing as many as we can.
You give us a suggestion, we'll go with it.
Yeah, we'll figure out how to get it in there. There's other ways to value banks too. We'll put them all in over time.
Corsair Gaming.
Okay, we've got, very reasonable free cash flow. You got some analysts. I don't know why that is dropping down there. 180 to 152. I wonder why analysts are projecting that. There's 5 analysts at both time periods. I'm assuming those are the same analysts. So overall, it looks quite undervalued. Look at even at 12.5%, it's undervalued. So, they don't have too much debt. No, overall, this one looks quite good. Current PE of 14x. I like it. Overall, I'd say this is a thumbs up. Whoever suggested this one.
I had quite a few
suggestions. Yeah, do a deeper dive on that because that looks interesting. Berkshire Hathaway.
Okay, Berkshire Hathaway.
So this one's a bit tricky, but by far the best way to value this stock is obviously, that might look insane to people. It's at $487,000. The reason for that is the shares outstanding. It takes all the shares outstanding, Class A and Class B. Class B, I believe, somebody told me they're 1,500 to 1. So there's a lot more Class B shares than there are Class A. This values them all the same. That's not the best way to do it. Buffett, for years, has valued his using price to book value. This is the valuation method I would stick with for his company. Buffett himself is benchmarked it to price to book value. These all look the same, even though that's going to be a rounding thing. But the red line, right now it's currently above the red line, so it looks like it's slightly overvalued. And by the way, if A is overvalued, B is overvalued, the two are going to move in unison despite their very, very different stock prices. So I hesitate on this one at this price, but it is a great company. It's more like buying an ETF. They're so diversified. Looks slightly overvalued, but if you can get that one to drop below its average, I think it'd be much more interesting. NEO.
Look at that revenue growth. That's a good warning there for you.
Yeah, so I'm guessing.
Warning's not showing again.
Oh, the warnings aren't showing again. What'd you do?
What'd you do? Wowzer.
Wowzer. You slip up one time and he doesn't let it go. Be careful. This is high revenue growth. That is high. But wait, what is that? That's my question. I'm guessing that's a font thing. 20? Oh, negative. Okay, so here's the way these numbers are working. They're not affecting this calculation because these are all analyst estimates. They're all green numbers. But if we wanted to project out, I'll project out one more year and I'll tell you everything is going to go negative. No, wait, not 1 year total. One more year, 4 years. It's going to be negative 35. So the way the calculation is currently set up to work, and we've already fixed this for the website, but the way the current calculation is set up is it takes the last official year, and then it grows out the revenue by revenue growth, and then it takes what percentage of that revenue is going to be transitioned, going to be converted into free cash flow. Here, because this number is negative, well, it assumes you're transitioning into huge negative free cash flow. So the way we would actually do that is, let's say we're going to go out 5 years. You would then need to reset that. So you'd say it's not going to be negative 133, which is illogical. It's going to be 15%. Well, now 15%, now again, I can't make up that number and then say, oh my God, that's a buy. You have to, that's the key to the research. We do the research and then say, you know what? I think over the long run, it could be 5%. It could be 25%. You could go in any direction. The point of the website is to make it easy for us to calculate. But in our case, we're better off just sticking with analyst estimates for now. This is the best default way to go because they did the research. Let them do the research. All right, does it look good? We could absolutely argue this is way too conservative because we get the fourth year, we're assuming 2.5% growth, which is not high enough. And given that our 7.5% gives it a fair value of 15 and the stock's at 16 right now, I'll bet you when we do our own adjustments after we've done our research, it is very possible. If we believe these numbers and we assume growth will continue after that, and I don't see why it wouldn't. If it does anything, we could look at Tesla's history and, because I believe Tesla's slightly ahead of what NEO's doing. If we look at their history, even if we take a conservative view of their numbers, I bet you it gets very close to, if not undervalued, close to fair value right now. It's close now. Okay.
Lots of requests for this.
Lots of requests. Hewlett-Packard.
Hewlett-Packard.
Do they not go by Hewlett-Packard anymore? Now it's just HP Inc.
That's too much to say.
Yeah. Well, we got plenty of analyst estimates. It looks amazingly undervalued. $4, 2% dividend yield, $4 in debt, $4 per share in debt. I mean, it looks fantastic. PE of 9.4. That is below the sector average of, by the way, this says sector. That's not. That's, I'm going to change it. Ooh, caps lock. What are you going to do? Industry. That's the industry. The sector would actually might be technology. But because the sector, it goes sector, subsector, industry, sub-industry. There might be one other one, but that's basically how it goes. That's how the sort of the pyramid works. But overall, yeah, we're moving right along. I like it. Looks fantastic. This is a good one to research.
Okay. SP. Oh, nope.
Simon Properties. Oh, wait. Simon Properties. This is REIT.
It's a REIT.
Okay, you could try doing it with discounted cash flow, but a lot of times REITs operate a little bit differently. Better than discounted cash flow, go to a price to adjusted funds from operations. Now, again, this will be one of the features we're adding to the website. Link in the description below if you want to sign up. But this one actually looks undervalued. Take their average. So price to adjusted funds from operations is about the same as earnings per share, right? And it's adjusted funds from operations because it is the money that they generate from their operations, which is obvious. But then if they sold a property, they bought a property, that would obviously skew their numbers a lot. This takes a lot of that out of play. So it's really, how's the business operating and how much am I paying? Right now, we are paying $10 for every dollar of operational earnings, operational profit. On average, we would have paid over this time period, over the 5-year average, we would have paid $15 for every dollar of operational profit. So according to that measure, it looks like it could be a good deal. So I'm not sure. Do you know any other REITs that would work the same way?
I think this is one they asked for O.
Or realty income. Yeah, same thing, same general concept. You do have some analyst estimates here. I just don't think that free cash flow is going to work the same way. Price to adjusted funds from operations. Realty income, this example, looks overvalued. So in between those two, Simon Properties might be the more interesting one. Now, given everything that happened and what the little I know about Simon Properties, I think they own malls and stuff like that, a lot of them. That might explain partially some of the stuff that's happened with theirs. But some of the reason why their stock might be lower than everybody else's. But overall, I'd say I'm leaning towards Simon Properties versus Realty Income.
Do you want to try a Japan stock?
Yeah, let's try it. Oh, yeah, by the way, we got a bunch of...
This just shot by. I don't know if it's going to work, but we'll go for it. 269. It did. There we go.
Healthcare company.
Now this is
Obla
Japanese
Healthcare. Yeah, so the way the website will be set up and the way this spreadsheet is set up is, as you may notice, there are no currency signs anywhere. Whatever currency the stock is being traded in is the currency you have to use. So a stock like Alibaba, sure, it generates its revenue mostly in China and they, use the Chinese currency, but Baba in the US is traded in US dollars. So we need to keep them the same currency. These are all I assume this is trading in the Japanese yen. So everything here will be in yen or will be in whatever the currency that it trades in. That's the way it's set up. So debt per share is 24 yen per share, I guess. Right? They have practically the same amount. Yeah, practically the same amount there. But overall, using 7.5% and using their own cost of capital. Now, 7.5%, I can logic out all day tied to corporate bonds, mostly in the United States. I don't know how much that applies overseas. I do not know what the government bond is over in Japan. I don't know what the Japanese government bond is at. That being said, using the defaulting to their cost of capital is probably the most logical move. So here, this one looks good. I mean, I like it. Whoever suggested this seems like a good one to research. Okay, back to the U.S. A.O. Smith, Building Products. A.O. Smith. Yeah, I mean, we got very reasonable growth. 18, 19 PE, that's fine, versus a sector versus their own 5-year average. A little bit of a dividend, $9.2 billion. I mean, the stock looks interesting. Yeah, overall, I see no real red flags with this stock. A lot of times when I'll do this, when you do these numbers, I'll point them out as we go along. But I like pulling them out and be like, oh my God, analyst is showing. Imagine that said 525, 50, $5.89. Well, what is happening next in 2023? Because analysts aren't going to make that mistake. There's going to be a reason. It's a great place to focus our research on. So, that being said.
A lot of Ford going by. Let's go see it.
Ford.
A lot of Ford. Wow, this is low. 14.
Yeah. Okay, now this is a good example too. You see this negative $4? Oh my God, 12.5%. Now, why is it negative 4? Because they have almost $24 in debt. So they're $136 billion minus their $41 billion in cash. Actually, a decent amount of cash takes away the value of almost $24 per share in value. So this 16 add 24, that's what it would be on a not debt adjusted basis. So if for some reason you want to do this on a not debt adjusted basis, add those two numbers, you're good. But even with that debt, you only got 2 analysts out here, which actually surprises me a bit, going out that far. But if we think those numbers are reasonable, this is where we do our research. If we do our research and we think that number is reasonable, well, if we think it's going to get up there, and based on what I've seen of what the company's doing, I think this is very possible. I like it. Yeah, Ford's a good one.
Where are we now? Eric.
Wow, look at that. That's a whole bunch of green.
I like a lot of green.
I usually find a whole bunch of green to be highly suspicious.
I'm a green guy.
So when to me, it usually makes me nervous when I see all green, because why is it all green? Like, it's one thing.
It means buy.
Yeah, it's one thing if it drops down and you understand what happened. A stock like Alibaba, you get, okay, fine. There's all sorts of risks there, but there's a why. It's a logical why. For me, I opted to buy Alibaba anyways. But here, ramping up, a big jump here, big-ish jump. Reasonable, very reasonable jump here. I mean, 4.8%. Yeah, our 2.5% in the following year seems perfectly fine. And the stock looks super undervalued. One of the things, when you see all green, one of my hesitations is, are we looking at a value trap? Because if we are, be careful. That's what we're afraid of. We don't want to get in a stock that's just going to not go anywhere, just fizzle out for a couple of years. And they were undervalued because they should have been undervalued because the company's not innovating or something like that. So again, we got to do the research first.
I think this is Allstate. I've been asking for it there.
Allstate Insurance Company. So I'm going to go with insurance, probably price to book value. Price to tangible book value. Yeah, insurance, same reason you do it for Berkshire Hathaway. A ton of their revenue comes from insurance. Comes from the insurance business. Geico, companies like that. But this one looks slightly overvalued. Current book, 1.5, compared to their average, 1.4. 5-year average, 1.5. Yeah, it has pulled back a little bit recently. Price to tangible book, same thing. Again, the two of them tend to be quite similar to each other. I would ignore this. Free cash flow. You notice no analysts are projecting free cash flow, and it's just not an appropriate valuation method. So to me, I would hesitate with Allstate at the current price, but again, the research should really lead the way.
Okay. About AMD.
AMD. This is an interesting one. So as some of you may know, I own Intel. Now, AMD's stock has got cut in half in like the past 6 months, however long it's been, but the stock has basically been cut in half. And to me, AMD looks super interesting. I would love to own AMD at a good price and own Intel at a good price. We got plenty of analysts, very reasonable growth numbers. We could, if we were to project this out, I'm just curious, if we were to go 6 years. Yeah, see, what it was is they're growing too much early on, so the computer's not calculating. Now, on the website, that's not going to be an issue, because what we're going to do on the website is, if you want to use analyst estimates, there'll be a checkbox. Check that box, and then the next year we'll say, okay, it's going to grow off of analyst estimates. So 5.7, 6.7, 7.6, and then 8.1, some such number, and it'll gradually decline to get us to our perpetual growth rate. The way the spreadsheet is set up, it doesn't do that. It goes off of the last real year. But on the website, you'll be able to use either one. You'll be able to, if you don't even want to use analyst estimates, you can uncheck the box and be like, I don't want to use analyst estimates. I don't trust those guys. Pick your own numbers by all means. But with this, you're getting mighty close to a fair value at 7.5%. They have a higher cost of capital, meaning the stock to pull back a bit further. But to me, this is getting real close to interesting. So overall, I like it.
Okay, Zim. Yeah.
-20. Oh, you know what it is? It's this. So whenever you see a negative number with discounted cash flow, there has to be negative free cash flow. So because this is super concerning. Why are analysts? Now, it's only one analyst. So does this analyst know what they're doing? I don't know. I trust the group as a whole. Any one person could be spot on. They could be way off. Give me a group of 5 of them, 10 of them. That's a lot of people looking at the same company. Just one, I hesitate. But this analyst thinks it's going to go from $3.2 billion in free cash flow down to 1, down to negative. That is dangerous. Now, if you disagree, we could always punch in our own numbers. Maybe we go to 2 years. Well, and then
slight difference, huh?
Well, so for me, that actually speaks to the suspiciously green number. If we made 2 years our default, well, it looks like $1.9 billion. And then because we have a perpetual growth rate of 2.5%, our growth rate assumes it grows forever at 2.5%. But analysts are actually projecting for this thing to go negative. And then, sure, our calculation is still assuming we get to 2.5%. So, but to me, that's super dangerous. This one would take a lot of research to understand why is that dropping off like that? Why are analyst, just one. Why is that person projecting that? If you could get a hold of their report, whoever they are, that would be interesting, but I hesitate on this one. 38% dividend yield is suspiciously high, too. Just pointing that out. That's on the left side of the screen there. UPS. Yeah, UPS looks interesting. So it's down negative 10% from the year before. Negative 10 to 9 points drop, so 10% drop from previous year's free cash flow. Then it goes up, then it goes back down. This might be one of those that, are they going to keep growing? That's where I'm starting my research. I want to know what they're doing with that. Why they get a low PE. They look like they could be a good buy. Low enterprise value to sales. That's what this section is, if you're curious. 2.5% dividend yield. Yeah, overall, looks like it could be doing fairly well. Could be an interesting one. I don't know. I just want to know, why is free cash flow not going anywhere? And you got enough analysts. That should be somewhat close to accurate. Okay, ASO.
Academy Sports.
Oh, I think we looked at this one before.
We have, yeah.
Again, it is suspiciously green. $15, added $15. That's 133s after the 15. 140s after the $15 drop. A low dividend yield. Why would a company like this pay a dividend yield? Growth. Reasonable growth. Yeah, nothing, when I look at this, nothing jumps out as me as like, oh, here's the problem. The only problem is the price. Why is it so far away? That, got to do the research on it. It looks like it could be a really good one. It really does. Why is it so far away? Is there something happening fundamentally with the business that we don't know about? But overall looks good.
We didn't do Facebook yet, right?
Facebook, yeah. We could do the big ones. Facebook, Google, companies like that. Facebook. Meta. So, okay. At 7.5%, they look fantastically priced. They have a higher cost of capital, which, by the way, cost of capital, I did a whole video on it. But cost of capital, there's a lot of things that tie into that. The interest rates tie into it. The treasury rates tie into it. The volatility of the stock tie into it. A lot of things do that. So that number will adjust from, if we did this same live stream a month from now or last month, you can check it. That number is probably different. They do vary. They do move. So one of the other reasons why I like a fixed rate. But We're expecting fantastic growth out the next few years. 176, that is certainly the more conservative number. At 10%, it looks undervalued. Maybe if we're being conservative, below 176 looks great. This is a stock I personally own. I think I bought it like 215, 225, something like that. So I didn't take the whack on it. Although I think I want to say the whack was lower at the time because I thought both of them were green when I had bought it.
You were definitely happy when you bought it.
Yeah, the stock has gone a little bit nuts since then. So I'm still happy with mine for the long run. I think over the long run, any company that generates free cash flow like this should do quite well. But
the hell, man?
Google. So I like Facebook. I own Google too. So 7.5%, 3,200. It's currently at 2,200. Now, Google is a stock I own. And one thing I want to point out, this is another good example of the cash. These calculations are accounting for the $160 per share in cash that the company has. Net cash or net debt. So they have more cash than they have debt. So if they paid off all their debt, they'd have $160 per share in cash. $1.5 trillion stock. I mean, we want to get conservative, wait for it to drop below their cost of capital. 21.95. So drop below 2,200, 21.95, and then add your margin of safety. Could be a great buy. I bought mine, I think 2,300, 23 and change. I've actually bought it a couple times as it's dropped down. I've slowly added to the position. Next time I update my portfolio on a video, I'll show you the changes that I've made because I averaged down Facebook, I averaged down Google, I averaged down a few different ones. So overall, Google's the stock I love just because look how much free cash flow they've generated. $100 billion in a few years. And we're being conservative because we're assuming 16% growth followed by 2.5% growth. So, I mean, this is a stock I love, but you really want to get this at a killer price, and it might get there. It keeps going lower. $21.95. Anything below that could be good, but you got to do the research.
All right, we got
Asana. Okay, so we've got a couple analysts. Okay, now this one is probably a bit small to be doing. I wouldn't be totally turned off by this right now, and I'm saying that because negative 159 in free cash flow, negative 113, 83. If I was researching this stock, I would actually start with analyst estimates. Granted, it's only one at that point, but let's pretend we trust those people for now. We've done our research and we say, okay, those seem like reasonable numbers. They're about to go positive in, hypothetically, 2025 for free cash flow. Well, if that's the case, then I want to grow that out a few more years. It wouldn't be reasonable to stop here. Now, if we extend this out further, we could, but the computer's going to take free cash flow to revenue, so the whole thing is going to go negative. I'll go one more year just to show you. Go 10 more years. It doesn't matter. It's negative. It all falls apart if you have negative free cash flow. This only works a little bit here because the last number was positive. That's why if we really want to get accurate with free cash flow, you got to go further. If we're going to do a small company like this, you might be better off going a enterprise value to revenue. Works with most companies. Here, enterprise value to revenue, they are below their 5-year average, 35x. By 5-year average, I mean 1-year average, because it looks like they just started trading in 2020. That is still quite high, 26x, just from the grand scheme of things, it's kind of high. But that might be a better way to do it because it's going, it's a more, what that doesn't account for is like margins, stuff like that. But if you're going to try discounted cash flow, you got to do the research and say, okay, maybe you try to go out a full 10 years and what are those numbers going to play out like? Okay, Shopify.
Interesting.
So this is actually really interesting. One, I have a warning here, careful, high revenue growth. We set the high warning to be anything over 40%. Not that a company can't grow, not that that is suspicious, but what we found is that there were some companies that you'd punch in and it would have such an obscenely high growth rate that it was illogical. And it was because we were pulling down the average and it was only around for 2 years and the average was 600%. So we just put up a warning like, hey, be careful about this. Don't take the default numbers. Use your own numbers. But in this case, my big question is we got them positive free cash flow, 148 million. followed by 73 million, followed by 752. Now, we have plenty of analysts here, so I'm assuming there's some logic behind this. Are they rolling something out? Are they doing something? What are they fundamentally doing to make this happen? Because once we have those answers, then we can project out further. Maybe you go out 10 years and you get with more accurate numbers. Our numbers aren't going to be that accurate right now because we're using 5-year averages. So that's 1%. But free cash flow to revenue might not be 1%. You might have to look at the industry average and maybe say, oh, by the way, we'll get the industry average up on the website so you can just see it there. You might say, you know what, that's going to be 5%, or that's going to be 15%. You look at a company like Microsoft or something, they have 30% free cash flow to revenue, maybe higher. So you can see that drastically changes the numbers. But again, got to do the research. That's why this is great for a lot of companies when there's enough analyst coverage. But Shopify, if it is a steal right now, without doing the research, we won't know. Okay. Let's see what he's got. Netflix.
Ever heard of it?
Netflixo. Didn't we just do a video on this one? I think we did, right?
Yes.
I think we did.
I like how you don't remember that.
There's a lot of stocks blurring together.
The last 2 weeks.
Yeah, all right. We just did it. So Netflix, it looks like. Oh, and I think I had done the research and I actually projected out further, if I'm not mistaken. I think I went out a few years because I remember playing with the adjustments that should be made. Where do we think they should be from a free cash flow to revenue standpoint? And I vaguely remember thinking, oh, maybe I kept it here. I forget exactly what I did with the final price. But my conclusion for Netflix was I like the company, but I don't like it at this price. I think there's still room to fall. I think that's what it was. Their free cash flow projections from analysts. I think they're too volatile. I think the likelihood of them nailing those free cash flow numbers are somewhat slim because, even if we project it out 10 years, it's somewhat irrelevant because if they have to spend all the money that they make to generate new content, this isn't like a Disney that can mix their free cash flow numbers for Disney Plus in with their parks and merchandise and movies and all of that stuff. Netflix is a little bit different of a beast. It's got to spend a lot of money. So we could argue discounted cash flow isn't the way to go. Maybe you go enterprise value to revenue. With that, it doesn't look all that bad. But for me, I want I prefer the numbers to be a bit more predictable, which is why I hesitate on a stock like Netflix. Okay, what else does Mikey have for us here?
It's not me, it's the chat.
First Solar. Okay, this is another good example of, first of all, they get $10 a share in cash, so that's cool. It's cool for such a small company, but negative, positive. So analysts are projecting that positive turnaround. We've got to then grow that out. 3 years isn't enough time. I can't have the computer do it because we'd use negative free cash flow to revenue. So we'd have to know, let's say if we went out 10 years, those are going to be negative, so that doesn't do anything. Maybe we adjust free cash flow to revenue to what? Maybe positive 10%? I'm making this up. But if you do your research, that's what you're looking for. What does the typical company in this industry, what are they? Maybe management is projecting how much free cash flow they expect to do. Come up with that number, and now you can make reasonable projections. I have no idea about this stock, but those numbers at first glance don't look all that unreasonable. In fact, they look mildly conservative for such a small company. But again, you got to do the research to see where it lands you. Okay, go ahead. Mikey's back. Or you guys are back, I suppose. Dow Chemical. Wow. Way undervalued, huh? Sector 23x price to earnings ratio. Company 6.6x. A 4% dividend yield. Wow. This one should be on the top dividend stocks. No, I scratched that. I hesitate on that. Here's why. Free cash flow. 5.6 billion, 5.3 billion, 5.1 billion. I don't know. I don't know. I don't like the direction. Yeah.
I don't like the direction.
What is happening with that? So if you're doing your research, this is where you got to start. Start at that research point. try to figure out what is happening. Why is that trending lower? Okay.
All right, we keep going.
What do we got?
Costco.
Yeah, might as well. Costco. Really? Now, see, to me, that seems suspiciously undervalued. Although, I guess it would be defensive. What if you went out further? Yeah, so the computer actually does a good job here projecting those numbers out, bringing the growth down in a more linear fashion. Yeah, I mean, maybe is it really just that overvalued? Costco's a company I love. I actually like the business. I like fundamentally how they do it, but it looks overvalued. And the numbers all seem reasonable.
Warner Brothers Discovery.
Warner Brothers Discovery. So, I actually own shares of this because I own shares of AT&T,
Yeah.
and the spinoff is happening. So this isn't really going to work. It's not going to do it. Well, it could.
It's too soon.
So here's the thing. These numbers are very likely fairly up to date. Last I checked, I was checking to see if analysts were updating their numbers, and they have been, as the Warner Media business has been pushed into the Discovery business. But we're missing something huge, you may notice, and that is the debt. So let me know in the comments if anybody has seen how much, what is the official number? I saw AT&T was getting rid of 40, 43 billion, 45 billion, some such number. But there were comments about, was it going to be debt? Was it going to be cash? Was it going to, not cash. Was it going to be debt? Was it going to be debt and cash? There's different combinations that could happen. But I heard it was like a 40, 45 billion dollar swing from AT&T coming over. I bring that up because 10 billion right here is taking away $4. Add another 40 billion to that. Well, we could actually probably do that math. And you're ending up, it could be undervalued. Now, add another 40 billion to that, 45 billion maybe. So what, 8, 16, $20 per share, give or take. Even if it was all debt, $20, it brings you down to 26. I'm roughly estimating. I got to do a deep dive on this company independently.
We need all the info.
Yeah, I'm just waiting for I'd like to see a quarter. Have they reported yet? Does anybody know? I'd like to see a quarter go by where they report their numbers, and so we can see their numbers independent of what was in AT&T. But I know I'm 87. I'm making that number up, but I'm pretty sure that they're supposed to be getting a whole bunch of debt, and clearly that number hasn't hit. Let the first quarter update. All this will update right after that, and there we go.
I'm 86.4% sure.
Yeah.
Like, that was such a weird number to throw out. I mean, wowzer,
A guy just can't have kids. That's the real problem. GoPro.
Yeah, GoPro.
Wow, okay. So again, suspiciously green. That's good. Maybe. Could be a value trap. My biggest question here is, look at this. Okay, one analyst in 2024, so take that for what it's worth. But down, up, it was up 13% from the previous year. Down, up. Just the one analyst, so whatever. But that down year, I want to know why. What is happening? Is the company going to be stagnant, not really grow, or is it doing something? Perhaps they're maybe they're doing things to innovate and to get push their product out there. So the question is, do they deserve this discount, or they get $1.61 in cash per share? Yeah, I mean, overall, and they haven't really generated. Look at this. This is the 5-year average, is what we defaulted this to. Again, on the website, you'll be able to change all of it. You could sign up in the description below how to sign up for the website. But negative 2.7. Yeah, so that they haven't really been making free cash flow. I would argue free cash flow is probably not the best valuation method. Enterprise value to revenue. This skews the whole thing. It makes it tougher to see. So it looks like it's below the average, but that's part of the average. So actually, it doesn't look bad. I mean, overall, I'm hesitant because it looks so undervalued, but overall, could be good. So I would do the research purely asking yourself, is it a value trap? Is it, are they going to grow free cash flow? That's the question. At the end of the day, that's the key to all companies. Today's, as Paul from Everything Money is always saying, that the value of any stock is today's value of future free cash flow. That is absolutely true. Buffett says it, Munger says it, Benjamin Graham says it. 90% of all the books that, out there on investing, that's what they're talking about. That being said, Boeing's the present value of future cash flows for Boeing says it's worth 257 if we need 7.5% a year. If we need 10%, which is their number, and you need 138, so you need it to drop a bit. Now, Boeing's an interesting one because Boeing has had a lot of trouble lately. So if I was doing my research on this, I see analysts having free cash flow ramp up a lot, but that's going to be because, I can tell you without looking at the numbers, that's going to be because free cash flow has been tragic over the past few years because of their many deserved issues. And the question is, do we think that's going to change? If we do, then we could take analyst estimates and project out until they get to, call it a year of normalization, where they get back on track, maybe project out a year or two. Then what's it worth? But it's close enough right now. This could be worth doing. This could be worth doing a deeper dive on, because maybe it is. Maybe it is undervalued at this point. Okay. Certainly close.
Had one that come up that we did in our private stream earlier.
Yeah, we do these. By the way, we do these live streams every week in the private investing community. We got off of that one. As soon as we got off of that one, we set up for this one.
We call it DCF Friday. We have a good time. We get to go through all the tickers at a slower pace, and we like to analyze them a little bit further.
And I've literally never said wowzer in all of that.
This is the first time.
Yeah, so
we're gonna make T-shirts. Learn to invest. Wowzer. All right.
All right. What do
you think of Box here?
Box looks good. I mean, it looks undervalued here. It's kind of small from a free cash flow perspective. We probably want to go out further. This might be an example where you extend it out. How do the numbers look? See. So on the website, again, we've adjusted the calculations on the website that there will be a box that you can say, use analyst estimates and then build off from there. You can check that box. And in this case, that's a more logical thing to do. Our projections are projecting off of the last official year, the actual numbers that were reported. So I don't think that helps us any. In this case, I think we're better off going with 3 years. So, but overall, I mean, it looks interesting. So I'd say, yeah, dig deeper into this one. This could be a good one.
TXN, Texas Instruments, I think. Yeah.
TXN, Texas Instruments, nice. Current price, 170. Fair value, 150, 110.
Semiconductors, huh? Oh, yes, it's up top.
Is that?
I'm so smart.
Is this the calculator company, Texas Instruments? Do they do semiconductors as well?
We've said that last time.
Did they? Yeah, you could tell.
We had one of these in high school.
I haven't really researched them. Yeah, I have like 4 of their business calculators. I use them for exams in school, but I never really thought of them as a semiconductor company. It's neither here nor there. They look overvalued.
We're probably wrong.
Yeah, I know exactly. 98% of the revenue will be, semiconductors.
2%.
Yeah, 2% for calculators. I don't know. Okay, moving along. It looks overvalued right now. Reasonable free cash flow numbers. Plenty of analysts. Cash, debt, nothing really there. Some dividend yield. I mean, overall looks interesting, but considering we saw AMD looking, if not undervalued, mighty close. Intel, we know, looks pretty undervalued. Or at least I think it looks undervalued. So overall looks pretty good. All right, what else we got?
All right, ready? WHR.
Whirlpool. We should try to guess the companies before.
I'm going to be tragically bad at this.
181. I mean, it looks super undervalued. So I think I've looked at this one before, and I think I was equally surprised then that their free cash flow was as low as it is. I mean, 1.1 billion is not bad, but isn't Whirlpool like a brand name? Isn't that like one? How long have they been around? I feel like they've been around forever.
I've known it forever.
They're up to 1.1 billion. You know what I mean? So many companies are getting there in like a year. Maybe that's an exaggeration, but you know what I mean. Either way, I mean, it looks interesting. 7 PE. Looks like it could be a great value. Do we think that free cash flow is going to keep ramping up? I don't know. I mean, overall, I think it looks pretty good. $68 per share in debt.
Real quick, guess the year this company started.
1952.
1911.
Really?
That's what it says.
Wow, 52. I was way off.
Wow. Interesting.
Okay.
I would have guessed the same area, though. You were...
What about AVGO? I said that one, Broadcom.
Sure.
I was thinking that when we were looking at a different semiconductor company. I think they do the same thing. Be careful. This is high free cash flow to revenue. Really? Okay, so I set that to 40% as well. But in our case, that actually doesn't matter because we're taking just straight up analyst numbers. So this is the 5-year average. So impressive that they're able to turn around that much. Still looks undervalued. At 9% cost of capital, I like that. To me, that's right in the sweet spot. Cost of capital, 7 to 10, I think is a sweet spot. There's going to be companies that are lower than that, but they're going to be the companies you think, defensive companies, probably utilities, food companies, Kellogg's, Kellogg's, General Mills, companies like that. Tech companies are going to have high cost of capital. They're going to be the super volatile stocks like Tesla, which surely is overvalued, at least using this valuation method. Using every valuation method. Yeah. What do we got? Broadcom looks good, though.
Interesting. Look at the analyst.
Analyst estimates. Okay, so these are our computer. Now, this is probably one of the examples. You can go out further using the computer set up the way it is. Yeah. And using 7.5%, you're mighty close to a fair value. WACC, you're way undervalued. They have a higher cost of capital. 10.3 is a little bit high. $83 billion, really? I don't know much about the company. So all we did is we took their numbers and we just sort of grew it out. And as you can see, we gradually decline it until we go to our perpetual growth rate. But that being said, yeah, I mean, it looks interesting, but you're going to want to add a margin of safety. So even if you added, a 20% margin of safety, even at 7.5%, you want to buy it below 17. 10% buy below 19. So it looks mighty close to being very interesting, but I would do, you got to do the deeper dive, see if the stock will do what we think it's going to do. Do we think 2025 they're going to be at $4 billion in free cash flow? If we do, then fine. We can now, what return do we need and what is our confidence in that? That can help guide you towards your margin of safety.
All right. What's CRM? You remember?
Yeah, that's CRM is
Salesforce.
Couldn't think of the name.
You're so close.
I'm very upset about that. Look at how many analysts they have. They have a ton of analysts. That's a lot. Very rapid growth. I mean, this one looks super interesting. No dividend yield, which is frankly good. They shouldn't be paying a dividend with their kind of growth. We could probably extend this out further. I don't know how much that's going to mess it up. It doesn't mess it up much at all. As you can see, our growth, we're going, it's very reasonable. And then we project out. But 215, where was it? 186. So even going out 10 years, these numbers, I have no issue going out if we want to go out further and gradually decline it. I have no issues with this. The question is, with the cost of capital being so much higher, I've back tested discounted cash flow on a bunch of different companies. And because I needed to have a reliable discount rate, I tried 7.5%. I tried 10. I tried 12.5. 12.5 didn't work because, it worked. Obviously it works, but it didn't outperform because so many good companies got left off the list. It didn't beat the market. 7.5 did outperform, but it wasn't fair because it was so low. You ended up spreading it out among so many companies. And that's because when I back tested, I go back to like the 80s or 92, I think I went back to. Interest rates are much higher than 7.5% is illogical when the Federal Reserve is, when the 30-year Treasury is trading for 7. That's an illogical thing. But when I use the company's cost of capital, it did very, very well. So here I hesitate a little. I like the business. I like the company. I like what they do. and it's so close to being a great buy. It might be there, but do the research and, see what those numbers project out to be. Our numbers might even be conservative, given how fast they're ramping up, all mid-20s, and then we start declining pretty quickly. This could be a very good one, but we got to do the research.
Okay, a lot of requests.
BJ's Wholesale Club.
Wow.
Why, are they down or something?
I don't know.
This is another one. I used to work at BJ's when I was in high school. And yeah, they're only $494 million in free
Now you're a
cash flow.
Costco guy because of that.
Yeah, now I'm a Costco guy. Turns out Costco paid much better. There's a Costco right around the corner. I didn't even look. But $21 a share in debt, no dividend. To me, I just don't understand. Why is that so low?
They're down like $3 today.
Are they?
Yeah.
Yeah, so, I mean, it looks overvalued at the current price. Do we believe these numbers? If I was researching this stock, I'm trying to find out where do I think cash flow is going to be. This company, frankly, has been around a long enough time that free cash flow should work for them. But why are they not generating more? I just don't understand.
All right, a couple more.
3M.
Three of them. 3Ms.
3M. Looks good.
Okay, all right, moving on.
Cost of capital, good. This looks good. Analysts, reasonable growth. I mean, it's 4% dividend yield, another interesting one. $25 a share in cash. I mean, by cash, I mean debt, not cash. So it's knocking $25 a share. But even with that, the stock looks good. Be more conservative here. Maybe I go with the 194, but look at that. Look at the margin of safety. You could add probably more 20% margin of safety. No problem here. So overall, this one looks super interesting. Then again, 3M's a stock I've never owned, but I've liked it for a long time, and it's never done anything. Like, it's been one of those that
It'll happen one day.
check the chart. Like, it hasn't done much, and it's been disappointing. It's, I keep expecting to pull it up, be like, I missed a 3M run. It's at 400 now, but it's just never happened. Super reliable company that apparently goes nowhere. But they're growing, so give it time. The stock market will catch up.
As a company, you gotta love the consistency, though.
Exactly.
All right, one more, we think.
One more. Let's fire it off.
They wanted PayPal.
PayPal. So I did this one not long ago. I like PayPal. I had some issues with it. If you want to check out our video on PayPal. I had some issues with how they defined average users. It was like you had to use it once a year or something. And I had issues with that, but it is in my bullpen. I did add it. Now, at the current price, so using 7.5%, 141, it looks like a steal right here. Cost to cap. Now, I would add a margin of safety to this. For me, I'm in the 20% range, maybe even 25%. But even at 25%, the stock at 7.5% still looks quite good. One of the reasons I would have a bigger margin of safety for a stock like this is because it's volatile, because it's somewhat risky. But overall, stock looks interesting. Now, if you want to get access to this website, again, we got links in the description below for how to get access. We do this live stream every Friday for the private community.
We do 3 live streams a week, which we do a portfolio live stream.
We do a portfolio. We're doing a research one, and then we do this every Friday, and the
research one.
And the research
one we do on Sundays. Tuesdays we do
actually
portfolio.
Sundays. I just switched it to Tuesday mornings. Huh? Turns out Sunday is difficult to do this stuff with kids. Yeah, it's terrible. Kids are real, they're a real blessing. So, thank you very much for sticking with us.
Wowzers, we had a good time with you today.
We really
hope you would join us in our community where we do this all the time and get to analyze the stock.
Yeah, we'll get this website up and running very soon. And hopefully you guys can help us, give us some ideas for valuation methods we want to do. If you come and sign up for the community, over on the Discord that we have, a private Discord. On the Discord, we have a channel called like Website Ideas. Any ideas for like, hey, I've been researching this stock and I can't find these numbers anywhere. Throw them up there. We'll figure out how to get it up there in time. We're starting with DCF.
We do this weird thing and we listen to those suggestions.
Yeah, we're going to keep evolving this thing and try to make it, the best research platform we can. So, thank you. We'll see you in the next one.